Now, the last couple of years, natural resources and commodity shares have really helped prop the market up. But, like me in the last couple of months, I've got a bit of an unseasonal cold. Now, I know I'm going to feel better in a couple of days, but our commodity share's going to feel better. Well, who better to ask than Graham Birch, who's manager of the aptly named BlackRock World Mining Trust. Let's see what he's got to say. You were one of the first people to predict a commodities super cycle, probably way back in 2000, 2001. And investors in the BlackRock World Mining Trust have certainly benefited from your foresight over the last 7 years or so. But there's been some weakness in commodities in general. How's this affected the recent performance of BlackRock World Mining Trust?
Well, obviously, we're not immune to those headwinds from the commodity markets. And the mining equities, which make up the lion's share of the portfolio, have been under a lot of pressure. So commodities had a bad month in July, so did mining equities. One of the sharpest sell-offs that we've seen in recent years.
And why has this happened, do you think?
Well, I think that people are looking at the drivers behind the commodity cycle, which has been this phenomenal shift of economic power from west to east with the growth of China and to some extent India. And those are obviously hugely populous countries where quite small changes in the demand dynamics have a big impact on the world supply-demand patterns. And that growth in China, people are looking at the impact of US slowdown on that Chinese growth, and they're looking for signs that this is the something which is going to impact the longevity of the so-called super cycle.
When we interviewed you for our Investment Trust Awards a few months ago, where you won Money Observer's Best Large Trust Award, you said that you were a firm believer still in the commodities super cycle. In fact, you thought it still had another 10 years to run or so. Given the weakness since then, are you still of that view?
Yes, I think so. I don't think that this broad sweep of history that we're in the middle of is by any means completed. I think that the pattern of urbanization in China and India and the industrial growth rates of those countries, I think, have clearly softened a little bit. But I believe that will be a short-term effect, and I don't think that the broad move of economic power in that direction in the world, I don't think that's anything like completed yet.
Following the weakness in metal prices and commodity prices, are you seeing some outstanding value at the moment? Because obviously we're seeing a lot of mergers and acquisition activity as well, and so there's a lot of companies obviously seeing value in each other as well.
Well, Andy, I don't think really that... I think you say that there's a lot of weakness in commodity markets, and that's true in some parts of the market, but there are parts of the commodity market where there really isn't that much sign of weakness. So if we look at what we call the bulk commodities, which is things like iron ore, metallurgical coal, manganese, the types of a lot of the minerals that go into the steel industry, those commodities are at record levels. These are not commodities that always catch the headlines because they are the prices are set by negotiation between the producers and the consumers, but those are at record levels. And so the companies that we're focusing on in the portfolio are some of the companies that produce those types of commodities where there's real strength, and that strength is ongoing. So companies like Rio Tinto, BHP Billiton, what was CVRD, now called Vale, these are the companies that at the moment form our largest investments. So we think that the earnings of those companies are going to be really, really strong this year and going into next year. And so the falls in their share prices have created a great deal of value. So we're looking at price-earnings ratios on those large companies of well below 10 times earnings.
So the trust is it's holding its own very nicely really over the last year or so. It's still in positive territory, obviously not recording the kind of performance it has over the last sort of annual 5-year periods, for example. But it's standing at around about 15-16% discount to net asset value. So I would imagine that you would say that investors in the trust now would be getting an extra bit of value because they're not only getting trust shares on a discount, but you're seeing an awful lot of value in the underlying shares that you're investing in.
Well, I couldn't have put it better myself. I think that's exactly how I see it. I think that the discount to assets is something that we've found quite hard to understand. But that discount is, I find it as a personal insult, frankly.
Could you give an example of a company right now which epitomizes everything that you're looking for?
The best companies are going to be the ones that have got the most resources, the longest life operations, hopefully the positioning on their cost structure so that they're going to be generating a lot of profits from that demand growth that we see over the next decade. And so we look for long life assets. These are big mines with lots and lots of reserves and profitable. So we're looking for cash flow generation. We're looking for strategic value. And that's, at the moment, those companies are the large cap companies in this sector. And
there must be quite a few of these companies which are in South America as well, because I note that about 25% of your portfolio is actually currently invested in, I presume, Brazil and companies like Vale.
That's right. Vale is a perfect example. It's got excellent assets on a price-earnings ratio for next year's earnings of 5 times.
I also know that you can invest up to 10% of your portfolio in physical metals and minerals and the such. Does it ever get that high in terms of 10%? And how do you gain that exposure to?
Well, at the moment we don't have any exposure to physical metals, and the reason for that is because we see better value in the equities. Now there can be times when that's not the case. You might, and for example, if we were expecting a very short-term spike in a particular commodity, like we saw earlier in the year with platinum, then it would be reasonable to expect that an investment in the physical commodity might do better than an investment in a platinum equity, because the platinum equity would not rise to reflect that spike.
Interesting to note that with inflation still on the rise and the dollar starting to strengthen, gold is also starting to fall now.
There are a number of key long-term factors that you need to consider. One is that production of gold from the mines is falling and has been falling since 2001. Now that is not going to change. We expect to see further falls in the future in output. Secondly, central banks. Central banks are not selling as much gold as they did in recent years. So the supply side is very, very favourable. But of course, in the current market, where people are following short-term trends, they see the gold price come down a bit from the levels it was earlier in the year, and they jump on that trend. At the moment, gold equities look much, much more attractive than gold bullion does. So in the mining trust, we are at the moment lifting our exposure to gold equities because we think that they've become too cheap relative to gold.
Is there anything that you can do as an investment trust manager, or that your board of directors can do on the investment trust to try and hedge volatility in the dollar?
Well, Andy, we've tried to do that on a few occasions, and normally whenever we try to do that we lose money for our investors. So after a few experiments in that direction, we've pretty much stopped trying to second guess the currency markets.
Do you find, obviously as a closed-end investment trust, you have a board of directors? Are they fairly proactive, or do they let you get on with things? Do they sort of say when, for example, you might want to raise gearing? Are you likely to raise gearing in the near future on the trust?
We have a very good board at the Mining Trust. Our chairman is Tony Lee, who's until quite recently was the CFO at Anglo American. And we have a strong board. They are full of opinions and advice, but they don't try and run the fund. With things like gearing, they give me guidelines for how much gearing I can take on, and we work with those guidelines, but they don't tell me when to gear. They leave that decision to me. And at the moment we have taken out some gearing recently. We've drawn down about £30 million of overdraft facility. We also have some other commitments that would give an equivalent of about 5% gearing right now.
Graham Birch, thank you very much for talking to Eyeball.
Thank you.
Thank you.